Hi, I'm Tom Lydon, editor of ETF Trends here in Chicago at the Morningstar ETF Invest Conference. And I'm here with Dave Mazza, head of ETF investment strategy at State Street Global Advisors. Dave, thanks for being with us today.
Thanks for having me here, Tom.
Listen, I know that State Street, being one of the top ETF providers out there, you've got multiple different strategies. But today, one of the hot topics in the advisor industry is how do you handle rate risk and how do you try to manage yield when there is that potential rate risk on the horizon?
Yeah, I think the recent concerns of tapering and then not tapering that the Federal Reserve has introduced to the marketplace has really wakened up advisors to the challenge that they have in managing portfolios broadly, particularly in the fixed income side, because we know that clients are still demanding and need yield in their portfolios, but introducing too much duration risk to get there is pretty impactful. So we really think investors would be well served by having a blank slate to thinking about fixed income and understanding that there are different approaches that we can take today. So if we think about introducing things like short-term corporate bonds or short-term high yield, or even some things with a floating rate mechanism, like floating rate investment grade, or even senior secured loans, which are going to benefit from a potential rising rate environment because they have that embedded hedge in there relative to fixed rate bonds.
So what we've learned for the past 30 years, you're basically saying it's not going to work like it used to.
Yeah, if you're in a 30-year bull run in fixed income, and if you're thinking of strategies that have worked there, I don't know if I'd be wanting to think about that back test approach. Yeah. I want to be thinking about the next 30 years and the different interest rate environments that we may be entering into. And it's not necessarily one over the other of where rates may go, but we want to build portfolios which could be resilient and more adaptive to changing rate environments.
What do you think the biggest challenges are for advisors that, really we learned in the last 30 years what worked, and to a great degree it did in the fixed income area? Are they not taking this seriously enough as a potential rate risk and what it can do to portfolios? Are they only maybe moving a little bit of the portfolio into other areas that may actually do okay during a rising rate environment? Or are they not doing what you've said, which is, hey, start with a blank slate and build it from there?
Yeah, I think that's a really good point. We've thought about these things in a very narrow focus, saying, I want a little more yield, so I'll add some high yield, or I want to reduce my interest rate risk, so I'll go with a shorter term or intermediate corporate bond type strategy. But I think the blank slate, as I said before, is really what we need to do. So we can think about getting income from different sources in the fixed income market, adding maybe convertible securities to benefit from a rising rate environment and introduce some more equity risk into a portfolio to benefit from a rising equity market as well. And then we also have strategies across multi-asset class. Think about the benefits that dividend-producing strategies can bring to a portfolio and balancing those with what we're doing on the traditional fixed income side.
So we have to look at it not just on the fixed income side, that maybe in the future some of our safest yield is going to be in the equity side.
Yeah, that's a really interesting point. I mean, it's not a one-for-one trade-off between
absolutely
taking a dividend-producing equity with a fixed income security. We need to recognize that. But when we now have something which used to be a yield that was guaranteed somewhat, and a really benefit from capital appreciation as rates came down tremendously, if that's not going to be the case anymore, you need to be cognizant of that significant interest rate risk and identify strategies that are going to meet client needs in a much more discrete and precise fashion.
And that requires a lot of education for clients, almost a change of mindset, right?
That's correct, yeah. So clients are going to have a lot of questions. This could be the first time in a long time that they're going to be seeing red in the fixed income portion of their portfolio. So that's going to raise a lot of questions. Yeah. They benefited from what they thought fixed income was, with principal preservation and a steady income stream. When they see those statements, it's going to require re-education about how different strategies, particularly ETFs, can be used to help navigate that adaptive interest rate environment.
Okay. So let's shift gears for a second. And State Street, being the proprietor of the largest physically backed gold ETF, GLD, there's been a lot of ups and downs in the gold market, but still, over the years, many advisors have created a specific foundation portion of the portfolio for their clients. Is that continuing to be the case in the future, or did they get caught up in, hey, we had a little bit of a run here, and clients want it, so I'm giving them their small portion, I'm not sure if it's going to work down the road.
Yeah, I think the one big change that we've seen this year is that certainly there's been a lot of questions about gold, and it's received a lot of headlines because of its performance. But what you mentioned, that foundation asset, the ability of gold to bolster portfolios over the long run is going to be even more important in the future, particularly what we think about maybe the adaptive interest rate environment. So the conversations we're really having with advisors and clients is really thinking about gold as a long-term holding, something that's strategic in nature and not necessarily one that you can tactically whip in and out of depending upon headline news or things of that nature.
Dave, great. We went around the world in a few minutes. I really appreciate your time today.
Thanks for having me, Tom.
Thank you.